Let's turn to Savita Subramanian, head of U.S. equity and quantitative strategy at Bank of America Securities. Savita, great to have you with us. You have said that you believe the market was pricing in infrastructure for a long time. And so are there any surprises in what Biden unveiled?
Yeah, I think that the market is pricing in the good news around infrastructure. And if you look at just a few different measures of valuation, market cap of the S&P to money supply, that indicator suggests that the market is expecting to see over $2 trillion of near-term stimulus, just based on getting back to some kind of average multiple. Now, I think to your trader's point, I don't think the market has necessarily priced in the negatives, which are how are we going to pay for this? And where I worry is that we're starting to hear more and more concern from investors on tax hikes. And while that's not necessarily anathema to corporate earnings for this year, we're still expecting to see very strong corporate earnings. We do think that, potential reversal in the tax hikes based on Biden's current corporate tax proposals could take as much as 5 to 10% off of earnings growth for this year. Now, remember, we're still forecasting about 20% earnings growth. So we still see strong earnings growth, but there is a pretty big differential between, kind of pre and post tax reform, what that earnings growth is going to look like. And again, I think the problem is we're likely to see fiscal spend and infrastructure spending over a protracted period of time, whereas tax hikes hit immediately, probably sometime next year if we see them. So I think that's the risk, is sort of the timing of the good news, the immediate hit of potential negatives.
That's an interesting point. That this stimulus to the economy will happen over such a prolonged amount of time versus the immediate hit. But the 5 to 10% earnings growth haircut, Savita, that is based on a 28% corporate tax rate.
Exactly. It's just based on the partial reversal in the Bush tax cut, and then the foreign earnings excess taxes.
So what does that do to multiples and for your expectation for the S&P 500?
Well, so we were kind of baking that in, and as you know, we're not super bullish on stocks. In fact, our target for the S&P right now is below where we are. We're looking for 3,800 on the S&P by year end. And, I continue to say I think that action this year is going to be in earnings, not in multiple expansion. But where you are going to see multiples continue to expand is in the cyclical GDP-sensitive areas of the market. So I'm a big fan of industrials, even though they've run quite a bit since, last March. I mean, I think that what we need to remember is, we've seen industrials and cyclicals and CapEx beneficiaries do really well since last March. But think about where we were last March. Last March, the world was ending. We were in a complete global collapse. Of course, stocks have gone up since then, but I think what's interesting is that we've seen new highs for tech, for every month since late last year, whereas we're only starting to see new highs in some of these industrials and CapEx beneficiaries. And on a valuation basis, consumption plays, COVID beneficiaries are still trading at premia in some cases to CapEx beneficiaries. So I think that there's still room to go in this cyclical kind of CapEx beneficiary trade. And I like industrials. I like select materials. I think there are pockets of the market that can do really well on a continued basis, even though we've seen such a strong run in some of these areas.
Savita, thank you. Good to speak with you. Savita Subramanian. For a look at some of the stocks that could benefit from the infrastructure bill, head on over to CNBC.com/pro. Let's quickly trade this. Tim, I'll go to you. She's already factored this in. She's factored in a 20% corporate tax rate and will stand pat on her estimates for the S&P 500. Make you feel better?
Well, I'm not sure. I think the market is yet to really address and pay for the taxes. So what she said about the companies that benefit most, and look at it, GM, a name I'm long, case in point. That stock did nothing for 5 years, nothing. And so talk about reinvesting in their business and talk about reinvesting in the things that are part of the infrastructure bill and the focus of this country, like EV and efficiency, and where they're creating jobs. So I think this is about multiple expansion. Remember, in terms of industrials and commodities, I don't want to buy them when they're cheap. I want to buy them when they're expensive. And that's what we're seeing. We're seeing them actually re-rate. That's the time to own them, to me, as an investor.
Shepard Smith here. Thanks for watching CNBC on YouTube.